Hey everybody, welcome to Trading Capital's daily analysis video here on Monday, June 13th. And what an epic sell-off today the markets had. Oh my goodness, the red was everywhere. It was a bloodbath, a typical Monday morning session bloodbath. Traders woke up and there was a massacre on Wall Street. And that's certainly a something that we have been calling for and position for. This is why we have been net short the market, and there are certain positions in our portfolio which we still carry longs, like Netflix, which obviously got thrashed and hit, which we'll go over and discuss. But this was a classic broad market sell-off. This is my sectors, all the sectors in the S&P 500. You can see every single sector down on the day, including energy, the strong sector that we have been monitoring for quite some time. So it just goes to show that even the strong sectors, consumer staples, got whacked. Really the only thing that was strong, which we'll touch base on later date, is the US dollar. But a tremendous sell-off in Wall Street. You can see here on the S&P 500 chart, it closed down minus 3.8% on the day. And the incredible thing about this is that essentially you have now broken in 3 hard days of selling, trading sessions of selling. You have broken now this key support zone that we were trading in. So now the question is, are we going to get a confirmation candle tomorrow? Could there be another gap down in the markets, potentially taking us into this major buy zone, swing tradable opportunity? It could happen that way, where we get a gap down tomorrow right into this longer term trend line that we have been watching. This is your pre-quantitative easing trend, or I should say your pre-COVID quantitative easing trend. You were still quantitating and stimulating the markets all throughout this era over here, but it just wasn't at the degree in which we were currently doing it, or we were doing it. So the big question is the markets are now entered oversold category again in this massive 3 days of selling. And will we get a bounce? It's hard to really think that the markets are going to get a bounce just due to the fact that interest rates are surging. Other key sectors like real estate have really taken a toll and an impact, and were hit and broken key support levels. But overall, will the Fed provide some sort of easing of the markets heading into this 2-day meeting tomorrow and Wednesday, or will they continue to jawbone the market down and really start to trigger a potential crash in equities? Time will tell. It's only 2 days, and then we'll know what the central bank's new economic policy guidance is. But that being said, we kind of just have to take it day by day. But nonetheless, on a technical basis, we are oversold. S&P gapping down. Let's just flip to the intraday basis on the S&P here. S&P, you can see this was our gap down from Friday's close to Monday's open. And the selling just commenced all day. You did have a rally trying to take out these previous highs, but you could not make a new high on the session, which means that the trend likes to make a new low. If you fail to make a new high, which we did, it looks to make a new low, and that's what we did on the session here. Notice how we did come into some support over here. You're into this pivot and this chop. I do think you can flush a little bit lower before we potentially get this next bounce, but you could also potentially get a bounce off of this Fed meeting and potentially them trying to reassure the market somehow. But in all honesty, I don't see how they are going to reassure the market. The Nasdaq was down 4.65%. We're going to flip to our longer time frame now to analyze it. But on a weekly chart here, you can see we're approaching this weekly 200-day moving average, which we didn't even take out on the COVID crash. So that's just something to note. The last time we took out that weekly 200-day moving average was in the '08 collapse, and that's essentially where interest rates and policies taking us towards, is that '08 collapse. So obviously there's going to be tons of support in and around this area, because we are talking about a more than a decade-long trend that we have kept intact. So just think about that. 1 decade. But this is the type of trends that are being broken. We have 100-year trend lines that are being threatened. We have 50-year downtrends in interest rates that are now breaking. So there's clearly a lot of trends that are being broken. And the fact that we are now approaching these levels with really no, in terms of a bottom in sight, in my opinion, I do think we slice through this weekly 200-day moving average at some point. But there most likely will be a technical bounce at that level, which we will be sure to play in the upcoming weeks. If we take a look at oil was really positive on the day. It did have an initial dump, but it managed to recover, and I think that was due to a sign of a flight to safety. Where can we park our money? Everything's being sold off, potential margin calls. So it's really being seen as a store of safety, but I do think oil is completely done to the upside, especially with the key data that I'm seeing in the housing market, and that's one of the biggest contributors to the oil and energy industry. But I just want to congratulate all, even despite having this down market, we were still able to close 3 winners. So congratulations on covering our Pfizer short for a beautiful 10.35% gain. We also covered our BX short for a lovely 12.6% gain. And then we also we also covered something else, which was our sorry, I might have not, just the 2 winners on the day. We covered the 2 winners on the day. My apologies. But nonetheless, it's good to start to unload some of those shorts, because you never know when that rip your face off bear market bounce is going to take place. And it always happens where the least amount of people expect it. And there's certainly tons of puts on the market now. As you can see, everything has been sold off today. Everyone's throwing the baby out with the bathwater. It's not what should I sell, it's what can I sell. I mean, even when you simply look at gold was one of the strong sectors. And look at this nasty reversal on gold. Now, the only bullish case that you have for gold is you're still making a series of higher lows. But this type of bearish reversal engulfing candle on gold is not a pleasant sight. And that just shows you how terrified and how panicked the markets were today, because when you see a sell-off like this, including equities, usually gold maintains or holds its value or even rallies, but it just shows you the power of rates, Fed policy, and typically gold does sell off on a historical basis heading into Fed policy. If you take a look at natural gas has closed down on the day, but there is still signs of strength there. As you can see by these wicks, it's continuing to be bought up. But I do think you are now putting in this bearish daily consolidation. We'll just have to wait and see when this is going to break down. The reason I still think this is going to break down, not only do you have the LNG export terminal that's now delayed, which should help the North American inventories, but you also have a massive decline coming in the real estate market. And I think that's the easiest thing to note on the real estate market, is this massive decline in the real estate market should coincide with a massive decline in energies. The amount of energy the real estate market requires to function is truly tremendous. And you can note here that we did a chart on the IYR and other real estate indices a couple weeks ago, and we were saying this is your key level of support that you wanted to hold, this 92.87, and we broke that with conviction. And one can say this is your confirming candle to the downside, because you made a new low here, closed at the low, which negated this pivot. You also closed outside of this channel, and today was your confirmation candle. The rise in interest rates are just too much. And this is really interesting, because this was your high at the beginning of the year in 2022. So we are now within 5 months of since we put in this high, and this IYR real estate ETF has now declined with today's action about 25%. So typically this has a 6-month delay compared to the physical real estate market. So considering we are now 5 months in, we're going to start seeing signs in the physical real estate market of slowing and eventually leading to a massive decline. Unless the Fed pivots and somehow says they're going to print more money and stimulate and continue to buy mortgage-backed securities at the rate they're doing, the real estate market has a lot of downside, and that's essentially what's going to take these equities and markets to their next down leg, is the real estate market collapsing. And that's certainly what we've seen. I mean, we had real estate holding these levels, and since real estate cracked, what did we see? We saw the spiders crack and make a new low. So everything coincides, and when you have a major asset class of real estate now taking a hit in the realm of, I believe it was roughly estimated around 100 trillion in terms of nominal value in the States, and now that's taking a hit. That's starting to falter. That's where a lot of average middle class wealth is tied up, and we'll just have to really start to see how it impacts people's spending habits and the overall economy. But the fact that you have now confirmed below, I do think it does open up a move down to the 78 level as a major technical gap fill there. But I do think at the end of this tightening cycle, there's a strong chance of the IYR in real estate coming to test the low range of this boundary. That's certainly in the realm of possibilities. And when you look at interest rates surged massively today. This is why the real estate just cracked and has caused tremendous damage, as well as equities. Is you have this massive move in the US 10-year. I believe the 2s and 10s did invert briefly, which is why it's rallying. And who would want to be taking the 10-year as a yield when you can get a better yield on the 2-year? So that just shows you the importance of interest rates and interest rate policy, because it is a monetary tool that will impact equities significantly, as algorithms and institutions need to reprice their models based off of what interest rates are doing. And the US 10-year is a very important one, and you can clearly see we've made a new high. And essentially it's really interesting to put into perspective. This is when the Nasdaq topped, was in mid-November of last year, and this is when the S&P topped in January at the beginning of the year. And rates have basically moved a whole 100% higher since we put the top in the indices, which is just something really cool to analyze and reflect on. That as rates continue to rise, and I do think they will, we're obviously going to have to go lower on the indices. And you can see by this channel now, we've recaptured, confirmed above this channel. Your resistance was the center point of the channel, which just so happened to coincide with your last breakdown area. So you have hit short-term resistance. You should start to consolidate sideways here, and before eventually making a move up to the top end of this range again. So by the time we're ready, the markets are ready to make that next interest rate push, it could mean that we're charging in and around the 3.84% mark. So that's going to be really interesting to see how the markets handle that. But I do think the US is tightening, and they're eventually going to break something. If we take a look at our Netflix long position, it's too bad that we couldn't sell out of our Netflix position. We were significantly in the money. Probably should have taken that off the table, or at least reduced some exposure. But we were trying to squeeze out some more profits here to see that inverse head and shoulders pattern complete its measured move up to the 218 mark here. So clearly we did not complete that inverse head and shoulders move. It's still technically intact. Now that you've had a retrace back to the original neckline, the breakout zone, the big question is, we want to see Netflix hold this level and start to mount a new rally if we're going to expect this pivot low to hold. But you're still technically holding this pivot low, which is a short-term relative strength signal when you look at the spiders. The spiders made a new low, the Nasdaq made a new low, but Netflix has not made a new low. So that's a short-term bullish signal. When you look at Apple, for instance, just remember Netflix held its short-term low, but Apple is now making a new low. So even Apple, one of the strongest, most profitable companies, not most profitable by now, but one of the most rich companies in nature, made a new low. So it just shows you that at least Netflix has some short-term relative strength and potentially still holding that key bottom. And it's going to take significantly a bigger decline in the markets, I think, for Netflix to break its key pivot low around the 162, 161 area over here. So short term, that is a positive sign. We did add to our Carvana today. If we just flip to the intraday chart, the 10-minute chart, you can see we actually added down here at 20:05. So I'll just adjust that green line. So 20.05, it did bring in our average. And the cool thing is that Carvana, despite the markets continuing to sell off late in the day, it actually rallied and is putting in the short-term intraday bull flag pattern, which looks likely to break out and at the minimum at least fill this gap. So Carvana is showing some better relative strength compared to other names because it did rally significantly off of the lows. And if we actually take a look at Carvana, let me just widen this daily chart. We do have a positive green candle. It did rally substantial off of its lows. Now, it did still finish down on the day, down 4%, but it is off of our ad level, which is healthy to see. I still think Carvana is one of those oversold names that once the markets do catch that short-term bid, this one could be up 20-30% in a couple trading sessions and will be significantly in the money. And one of the reasons why we added today, you're again into this choppy tons of support over here, all these major pivots and this original breakout zone. So that is a key place to add. You did break your COVID low, so I do like the fact that now the chart on a technical basis has made a new lower low. And just for my point of reference, I just want to see how this trend line matches up. So you can see we kind of had that major capitulation zone. You can argue that you do have more downside all the way down to this trend line eventually, but I do think we bounce before we head all the way down to this 11.13 at the end of the bear cycle. So Carvana is showing that good relative strength, so I'm happy to see that it is off of our ad level. So we'll just continue to slowly accumulate. Markets will catch that bounce despite there's so much fear in the markets. We just have to kind of continue to buy like a robot, where you got to buy into fear. If you're not accumulating these names as a swing trader when the sell action is taking place, you're not going to position yourself properly for that inevitable technical bounce, which is what we thrive off of as traders. You know, there's still opportunity in these markets to make money, and you just have to take note that over the last few trading sessions, Carvana has shown more relative strength in the sell-offs compared to it closing way off of its lows in each trading session. So that's generally healthy to see at that point in time. So again, congratulations on the couple winners that we closed today. We just took a couple of our shorts off. We did also pick up Spotify again. So I do like Spotify at a technical level and at a fundamental basis. The fact that you're trading below IPO levels when you have way more revenue, your PE ratio is trading at one of the lowest it has in forever. Very, very good as a trader because you're buying at depressed levels. But when you look at the support that we're still trading in on Spotify, you can see that we originally played Spotify for a double-digit gain. I think it was like close to 20% gain that we banked off of this move. And now you're back into this key gap fill area. So you're keeping this bull flag inside bar bullish pattern on a technical basis, and you filled that key technical gap today and have actually rallied off of our level. So we picked it up around 97.29, so right around this green level. Basically right at that gap fill, we picked up Spotify, just a small 1% accumulation. If it does go lower, the next ad level that we'll look to do is on this yellow trend line, probably around the $90 area. And maybe we'll wait till this double bottom area around a pierce of $90 per se. But I do think Spotify's business model, since they have way more, they're making a lot more revenue compared to their initial IPO. They have a lot more subscribers. Their company is just positioned at a way better place to succeed over the long term. And they are a profitable company. They're making money. They have a good business model. They have a consistent business model. And I do think over time this can continue to see upside, over the short term as we accumulate at these key technical levels. So we'll just have to wait and see and continue to monitor these crazy epic markets. But it's wonderful to see that a lot of our short positions are starting to put us in the money nicely. We have taken some off. We're starting to accumulate longs, but you have to constantly be maneuvering with this market and, covering your shorts into the falling weakness of the market and then buying some longs into the weakness of the market. So you're always looking to trade the market where it's heading and likely to head. And obviously, you want to trade the oversold bounces, and you want to sell into the strong bounces that occur. But this market will head lower over time, and that's certainly what we're seeing today by making a new low on the S&P, a new low on the Nasdaq, and basically new lows on many of the major tech plays. So it's really, really not an investor's market out there, and you still have to be nimble, not over leverage yourselves, not get crazy, but we still have tons of shorts on the table if the market goes lower. But if we do get a rally, we will be looking to offload more longs. But at the end of the day, we're still printing profits in one of the worst stock market wealth, destruction events in our human history. And the sad thing is that it's not even over. So let's just continue to monitor the price action. Flip to natural gas. Natural gas got 2 minutes left on this candle. So it is going to close down on the day, but just slightly, closing down just under 1%. But we'll just have to keep monitoring this price action. This is obviously our next big position that we want to look to bank profits on. And that will be a tremendous, tremendous winner once we do have that inevitable collapse in the markets. And I do think what's interesting is in our previous videos, just touching on the S&P 500 again, we did say that the markets are in that basically that 1, 2, 3, 4 lower high scenario that's following the same 2008 cycle and the same 2000 dot-com cycle. The markets made 4 lower highs and then they crashed. This is starting to look like a potential crash. This is how crashes start, where you have massive moves. This is a crash already from basically trading in this bull flag pattern from 412 all the way down now to a new low. That is a semi-crash that could open up an algorithmic crash, this week. And that would follow to a T the exact same cycle as the Nasdaq and the S&P did in the years 2008 during the GFC crisis and in the year 2000, the dot-com crash. So don't be surprised if we wake up to more blood in the streets. But as a swing trader, we are still comfortable at accumulating into these key technical levels and oversold levels. You have to be able to buy into the fear when people are liquidating and selling everything. And I do think it was partially a margin call selling that has taken place with this amount of downside. We also had Bitcoin collapse over the weekend, Ethereum collapse, crypto's getting demolished. So tons of liquidity issues could start popping up over the near term as markets continue to decline. Thank you again for being members. Stay tuned for more trade alerts. There's certainly going to be a lot of activity this week. There already has been a lot of activity this week. So thank you again for being members. Hit the like button below, comment, subscribe. If you want to know any technical analysis on certain individual stocks or names, feel free to leave me a comment on any of the videos down below, and I'll try to fit in some TA and some fundamental analysis from a macro standpoint